What is happening, crypto crew? Get ready for a rapid-fire rundown of the biggest stories shaking the digital asset world. The market is moving at lightning speed, and if you're not plugged in, you're missing out. We've got critical shifts happening right now that could redefine how we interact with digital finance. From major players making bold moves to subtle indicators pointing to significant trends, this is the intel you absolutely need. Stay locked in because the next big wave is building, and we're breaking it all down for you, right here, right now. First up, we're diving deep into the shifting tides of Bitcoin. Is the king of crypto consolidating power in fewer hands, or is something else brewing beneath the surface? We'll explore the data that suggests a major reshuffling is underway, impacting everything from transaction fees to institutional flows. What does this mean for the average investor when the whales are making their moves? Then, we're shifting gears to look at a monumental move by a major exchange. They've just transferred a significant amount of Bitcoin to an institutional custody platform, signaling a major evolution in how digital assets are being secured and managed. This isn't just about storage. It's about aligning with global financial standards and attracting institutional capital. What does this mean for the future of crypto custody and the broader market? But wait, there's more. We're also dissecting Bitcoin's current price action, pinpointing the exact levels traders are watching as critical. Is this a make-or-break moment for the digital asset? Plus, we'll examine a new theory that challenges the traditional way we understand Bitcoin cycles, suggesting a pattern entirely independent of halving events. Could this be the key to unlocking future market movements? Don't miss it, hit that subscribe button and ring the notification bell so you never miss an update. The Great Rebalancing, Bitcoin's shifting investor landscape. Is Bitcoin consolidating power in fewer hands, or is something else brewing beneath the surface? The trajectory of Bitcoin is notoriously difficult to predict, often leading to speculation rather than concrete analysis. However, certain on-chain data points, when examined together with ETF flows, fee reductions, and whale movements, reveal a clear pattern. A significant reshuffling of the deck is in progress. Bitcoin, once a playground for the curious and the bold, appears to be transforming into a hunting ground for the most powerful entities in the financial world. This shift raises critical questions about what comes next for the dominant cryptocurrency. The widening gap between whale activity and retail engagement is stark. This past week, the Bitcoin network experienced a notable drop in active addresses, falling to 692,000, a decrease of 2.2%, and falling below typical statistical thresholds. Concurrently, on-chain volume surged by 7.8%, reaching $10.3 billion. The question remains, who is driving this substantial increase in movement? The data strongly suggests it's the whales, the large holders of Bitcoin. Further evidence of this trend comes from the sharp decline in transaction fees, which plummeted by 17%. This significant drop is a clear indicator of reduced retail participation. With fewer small investors making transactions, there's less pressure on the network's blocks, leading to fewer movements from this segment of the market. The institutional side mirrors this sentiment, with American crypto ETFs recording substantial net outflows totaling $1 billion this week. Glassnode's recent analysis corroborates this observation, stating, on-chain demand weakened as activity declined, profits faded, and caution grew among traders and institutions. This cautious sentiment is also reflected in individual wallets. The network value to realized value, NUPL metric, has dropped to 5%, and the share of the supply held in profit has fallen to 91%. The initial euphoria that characterized earlier phases seems to be steadily evaporating. However, this apparent calm in the market is merely a facade, particularly during periods of price pullback. For astute market participants, every Bitcoin dip presents a strategic opportunity. These players are quietly but methodically advancing their positions. The Glassnode report further supports the notion of a strategic crypto repositioning, highlighting shifts in market structure from euphoria to fragility. Both spot and futures markets show weakened momentum. Options data indicates a growing need for hedging, and ETF flows reveal institutional caution. Even the realized cap indicator, which tracks the total value of all Bitcoin at the time they last moved on-chain, confirms this slow accumulation. Its 3.2% rise signifies a moderate yet steady recovery. Behind the scenes, strategic adjustments are being made and plans are being formulated. The expectation is that when the market eventually rebounds, these well-positioned actors will be ready to capitalize. While Bitcoin currently appears to be dominated by strong hands, another intriguing dynamic is emerging. During sharp price drops, billions of dollars migrate from Bitcoin to Ethereum. Whales are actively moving their assets, exploring new potential investment avenues. This raises a compelling question. Could the next significant market momentum be building elsewhere, perhaps on a different blockchain? But is this the whole story, or are other forces at play? Next, we'll break down a major exchange's move towards institutional-grade custody that could reshape crypto security. Binance elevates custody, a new era for institutional crypto. Binance has transferred a significant amount of Bitcoin to an institutional custody platform, signaling a major evolution in how digital assets are secured and managed. Binance, the world's largest cryptocurrency exchange by trading volume, has recently transferred 503 Bitcoin, valued at approximately $55.79 million, to Ceffu, an institutional custody platform. This strategic move, as tracked by Whale Alert on August 27, has sparked considerable discussion regarding its implications for Binance's institutional strategy and the broader market dynamics surrounding the custody of digital assets like Bitcoin. This transaction is emblematic of a growing trend within the industry, where major exchanges are increasingly prioritizing institutional-grade custody solutions to safeguard substantial volumes of digital assets and to better align with evolving global regulatory expectations. The decision to utilize Ceffu, a platform specifically designed for institutional-grade custody services, underscores Binance's commitment to fortifying its custodial infrastructure. Institutional custody platforms typically offer enhanced security protocols, stringent compliance measures, and robust operational safeguards, all meticulously tailored to meet the demanding requirements of large institutional investors and sophisticated asset managers. Considering Binance's existing custodial responsibilities and its aggressive expansion into institutional markets, this transition likely represents a broader strategic initiative to harmonize with international financial standards and, crucially, to attract capital from traditional financial players. This move also complements Binance's recent ventures, including the establishment of a $1 billion BNB treasury and strategic partnerships with family offices, all of which clearly signal its focused push into institutional-grade asset management. Custodial movements of Bitcoin have garnered increasing attention from market observers and analysts, particularly in the wake of recent market turbulence. A significant whale investor recently offloaded a massive 24,000 BTC, triggering a sharp sell-off that briefly pushed Bitcoin's price below the $109,000 mark. Analysts suggest that early investors, often referred to as OG whales, who acquired Bitcoin at substantially lower prices, are a key factor. These long-term holders possess significant portions of the total Bitcoin supply, and their sales require substantial new capital inflows to be fully absorbed, potentially slowing down the pace of price appreciation. Furthermore, custodial activity often serves as a critical barometer for overall market sentiment. In recent months, Binance has witnessed substantial inflows of stablecoins, reaching a net deposit figure of $1.65 billion. Historically, such trends have been interpreted as indicators of renewed capital entering the spot market, suggesting that traders might be preparing to re-engage with crypto assets following periods of heightened volatility. Simultaneously, the exchange has also observed significant withdrawals of Ether, pointing towards a complex interplay of capital reallocation strategies and risk management practices among investors. The movement of Bitcoin to specialized institutional custody platforms like Ceffu is also highly relevant in the context of increasing regulatory scrutiny surrounding crypto custodianship. Regulatory bodies across various jurisdictions, including the United States and the European Union, have consistently highlighted the paramount importance of robust custodial safeguards to mitigate risks such as theft, fraud, and operational failures. Binance's strategic decision to partner with Ceffu aligns with a broader industry-wide shift towards more secure and compliant custodial solutions, especially as institutional investors continue to increase their participation in the digital asset market. This transition is poised to bolster confidence in the long-term viability of cryptocurrencies as a legitimate asset class and may well establish a new benchmark for other exchanges to emulate. While the immediate impact of Binance's custodial relocation on Bitcoin's price remains subject to market observation, the prevailing sentiment in the broader market is one of cautious optimism. Bitcoin's price has recently demonstrated signs of stabilization, recovering above $111,000 after its brief dip below $109,000. Analysts remain divided on whether this stabilization marks the beginning of a sustained recovery or merely a temporary pause within an ongoing bearish trend. The forthcoming months are likely to be characterized by further market consolidation as participants digest evolving macroeconomic factors, including potential interest rate adjustments and the dynamic development of regulatory frameworks. But is this the only major development shaping the market's near future? Now, let's pinpoint the critical price levels that traders are watching as Bitcoin faces a crucial test. Bitcoin at the crossroads, $110 K defense crucial for bulls. Bitcoin price must hold above $110,000 to avert further losses, with key indicators flashing cautionary signals. Bitcoin's price experienced modest gains on Wednesday, inching up 0.9% over a 24-hour period to trade around the $111,000 mark. However, the sentiment among analysts is one of heightened vigilance, as several key figures have identified the $110,000 level as a critical support zone. Failure to maintain this threshold could precipitate a deeper correction, making the immediate price action pivotal for the digital asset's short-term outlook. Swissblock, a private wealth manager, articulated this sentiment in a recent post on X, stating, "BTC is at a make-or-break level." The firm further emphasized that Bitcoin's lifeline support resides at $110,000, a level that must be defended by bulls to sustain the ongoing bullish trend. This perspective is echoed by Bitcoin analyst Alpha BTC, who presented a chart highlighting the $110,000 to $112,000 range as a crucial area for Bitcoin. According to Alpha BTC, a 4-hour candlestick close above this zone is necessary for a potential rebound, while a failure to do so could signal a descent towards the $105,000 level. Investor and trader CryptoStorm noted that Bitcoin is currently maintaining the $110,000 $112,000 support, describing it as the key battleground. This consolidation around critical support levels is occurring amidst several bearish indicators that suggest a potential downturn in the coming days or weeks. Bitcoin's price has deviated approximately 11% from its all-time high of over $124,500, reached on August 14th. This drawdown has prompted a more cautious stance among investors, with CryptoQuant analyst Ga observing that this situation reflects a perception that the market may be overextended. A particularly concerning metric for the bulls is the Bitcoin taker-buy-sell ratio, which currently stands at. This ratio, a gauge of market sentiment, indicates that bears are in control when the value dips below 1, signifying that sales are consistently outpacing buying activity. Ga elaborated in a Tuesday QuickTake analysis, stating, "This signals that, despite Bitcoin's recent appreciation, the market is showing pessimism and caution." The historical context for such low levels is significant. The last time similar readings were observed was during the peak of November 2021, shortly before Bitcoin entered a prolonged correction phase after reaching its then all-time high around $69,000. Further reinforcing the bearish outlook, network activity has also shown signs of waning. Glassnode data reveals a 13% decrease in the monthly average of change-adjusted transfer volume, dropping from $26.7 billion to $23.2 billion. This decline in network activity supports the cautious case for Bitcoin. The market intelligence firm commented, market structure shifted from euphoria to fragility. Spot and futures show weakened momentum, options signal a need for hedging, and ETF flows reveal institutional caution. Despite these bearish signals, some optimistic indicators persist. A positive Coinbase premium, which reflects demand on the exchange relative to futures markets, and the recent return of positive flows into spot Bitcoin ETFs have rekindled hopes for a potential market rebound. These factors suggest that while caution prevails, underlying demand could still provide support. But what if traditional market cycles are no longer the best way to understand Bitcoin's movements? We'll explore a new analysis that proposes a Bitcoin cycle model completely independent of the halving events. Beyond halving, new Bitcoin cycle model challenges conventional wisdom. An on-chain analyst proposes a novel Bitcoin cycle model that decouples from traditional halving events, focusing instead on adoption and market structure. Throughout its history, the first cryptocurrency, Bitcoin, has been perceived to follow distinct cycles, often closely tied to the network's halving events, the programmed reductions in mining rewards. However, on-chain analyst James Check has presented a compelling argument suggesting that these cycles may not be intrinsically linked to halvings at all. In his view, the prevailing patterns are more accurately attributed to trends in user adoption and the evolving structure of the market itself. Check identifies key transition points, such as the market peak in 2017 and the significant bottom reached in 2022, as critical junctures that define these alternative cycles. Check's analysis, visualized through a chart that color-codes these distinct cycles, posits that regardless of the specific mean reversion model employed, the fundamental transition points and the inherent nature of market changes remain consistent. He further contends that the post-2022 bear market marked a significant shift. Consequently, investors who rigidly adhere to the classic halving-centric cycle models might be overlooking crucial signals due to what he terms historical noise. This perspective suggests that past correlations with halving might have been coincidental rather than causal, especially as the market matures and institutional participation grows. While Check's hypothesis offers a fresh lens through which to view Bitcoin's market dynamics, it stands in contrast to the prevailing sentiment among many market analysts. The majority continue to rely on the established halving model as a primary framework for understanding Bitcoin's cyclical behavior. For instance, Glassnode, a prominent data analytics firm, has previously stated that Bitcoin continues to exhibit patterns consistent with its 4-year cycle, which is directly influenced by halving events. Their observations indicate that following a price surge to record highs above $124,000, long-term investors have been actively taking profits. The volume of these sales has been comparable to peak values seen in previous cycles, with the notable exception of the 2016-2017 period. Adding another perspective, Blockware researcher Mitchell Askew offered a prediction in July 2025. He anticipated a potential end to the era of parabolic rallies or devastating bear cycles. Askew's reasoning centers on the increasing influence of institutional investors, whose participation is believed to be altering market dynamics and, consequently, reducing overall volatility. This suggests a future where Bitcoin's price movements might become less extreme, diverging from the boom and bust cycles of its earlier years. This divergence in analysis, between models tied to halving and those focusing on adoption and market structure, highlights the ongoing debate and evolution in understanding Bitcoin's market behavior. As the asset class matures and attracts a wider array of participants, it's plausible that new analytical frameworks will emerge to better capture its complex dynamics. So, what's the takeaway from all this market movement? We'll wrap it all up with a quick recap and a call to action to keep you ahead of the curve. And that's a wrap on today's essential updates. Bitcoin is seeing a major shift with whales accumulating and retail pulling back, while a major exchange is upgrading its custody solutions. Plus, Bitcoin is at a critical price level, and a new theory is challenging our understanding of its cycles. Stay informed, stay engaged, and make sure you're subscribed and have that notification bell on. Like this video, share it with your network, and follow us on all social platforms for even more real-time insights. We'll see you in the next one.